Okay, so last time we discussed about section 28. Now we'll go to section 29, improperly accumulated earnings tax. So what's this all about? The improperly accumulated earnings tax, section 29 is, well, the corporation or a corporation is not allowed to improperly accumulate the earnings. If they improperly accumulate the earnings, then they should be taxed. The idea there is they should the earnings should be distributed to the stockholders, because if they distribute the earnings to the stockholders, then you remember section 24b2, for individuals they would be taxed at 10%, and for intercorporate dividends that would be for domestic to domestic and domestic to non or resident foreign corporation, that's tax free. And for the non-resident foreign corporation, which we just discussed, that would be 15% final withholding tax. So that's the idea there, that corporations are not allowed to, or actually they are allowed, okay, to accumulate earnings, but on only as reasonable as it can get. If you remember your corporation code, there is a similar provision. That's section 43, second paragraph. Here, stock corporations are prohibited from retaining surplus profits in excess of 100% of their paid-in capital, except when justified by definite corporate expansion projects or programs approved by the board of directors, or when the corporation is prohibited under any loan agreement with any financial institution or creditor, whether local or foreign, from declaring dividends without his consent, and such consent has not yet been secured, or when it can be clearly shown that such retention is necessary under special circumstances obtaining in the corporation, such as when there is a need for special reserve for probable contingencies. Now, this is the provision in the corporation code. So there's a similar idea that if the corporation retains surplus profits in excess of its 100% of its paid-in capital, then that is a violation of the corporation code, because there is this word, prohibited. But for purposes of our subject or topic, this improperly accumulated earnings tax, is all about just the same. They are, or the corporations are prohibited from improperly accumulating the earnings. Okay, but there is this, the tax here, okay, is 10% of the improperly accumulated taxable income. How do you compute that? Here you go. You just read this class because it's more technical. It's more on the accounting side of it. But there is this term, reasonable needs of the business. So if you are going to answer, if there's a question about improperly accumulated earnings tax, then you just cite this, or if there's a problem, and if you think that the accumulation of the earnings is reasonable, then you just cite this provision. The fact that, or you may play around with these keywords here. This one, corporate expansion, or when it's prohibited by any loan agreement, or when it can be clearly shown that the retention is necessary. So that's reasonable needs of the business. Okay? And remember that there are corporations that are exempted from this tax, and they are the IBP or the BPI. Who are they? They are the banks and other non-bank financial intermediaries, publicly held corporations, and insurance companies. BPI, system glitch? No. But okay, banks. Why? Why are they exempted from paying improperly accumulated earnings tax? Banks, by the very nature of their um, business, is they require or they should be liquid, and they always provide contingencies, and they should have this, what they call this in the banking sector, the capital reserve. Okay, they are mandated by the Banco Central to maintain so much fund, and because if if you declare dividend, especially cash dividend, then your cash position would obviously be affected, and banks cannot afford to, to have a fund which is less than what the law provides or mandates. Publicly held corporations, those you know this, right? Those corporations which are listed in the stock exchanges. Okay, because they are publicly held, then there's no need for them to be taxed because the public will clamor for the dividend. Otherwise, nobody will invest on the stocks that they offer in the stock exchanges. Because why? If you're not going to give away dividends, why would you invest on that? Unless you're trading in the stock, which just a few people do. But that's the idea. Publicly held corporations, the public will not invest on a corporation that doesn't give any dividend. Or if there's a dividend, it's like once in a blue moon. So why would I invest on that? And insurance companies, just like banks, they also have, I think, this capital reserve or fund reserve, just in case there's the nature of the insurance business, right? So just remember the companies that are exempted from paying or allowed to accumulate its earnings, okay? And they are not covered by improperly accumulated earnings tax. Next, we will discuss Section 30, and I will break this into 2 to 3 modules maybe, because this is just the St. Luke's, and you remember the new one, the De La Salle case, and other discussions in Section 30. Okay, and that's it for Section 29 about improperly accumulated earnings tax.